Hi, ladies and gentlemen. Welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Welcome to the IFRS seminar on new developments. I'm Professor Hintie van Wyk. With regards to the new developments, I will deal with the following aspects. I will first do revision of the standards over the past 3 years during COVID. I will also do the new framework, just certain aspects thereof. I will look at presentation. I will look at integrated reporting as well as sustainability reporting. I'll also look at the revenue standards as well, the new revenue standard. I will look at the right of use asset under assets as well. I will look at financial instruments, just the impairments thereof, and then I will deal with lease liabilities. One can actually link right of use assets with the lease liability, but I'm doing it in different sections. All right, and then finally I will look at the ISB's work plan, what they have in the pipeline. All right, so let's start. Just the revision of the standards over the last 3 years. First of all, IAS 8. They fiddle around with the accounting policies, with changes in accounting estimates in particular. They say when the monetary amount is subject to measurement uncertainty, okay, one should mention judgments and assumptions. So that should be disclosed. What judgments and what assumptions that you use in order to measure. And also you have to highlight the techniques that you've used as well as the inputs that you've used in order to make an estimate. Very important is also highlighted very clearly now that it is an accounting estimate. Right? When it's not an error, it should be an accounting estimate. But I want to explain this a little bit. When you change an estimate and it's due to new information, then it is an accounting estimate. When you do an estimate and you use old information, then it's an error. So if you use old information that you should have had, then it's an error. If you use new information, then it's an accounting estimate, regarded as an accounting estimate. It's just highlighted now, it's just underlined now in the new changes, paragraph 32A and 32.4. If I carry on with leases, if there were rent concessions during COVID, okay, they will not see it as a lease modification. That's the first thing. And when you do the remeasurement of the liability, lease liability, you can use the original discount rate. Like any remeasurement of the lease liability will go to the right of use asset, of course. If you look at IFRS 1 or IAS 1 rather, let's move it IAS 1 rather, IAS 1, presentation of financial statements. They changed significant accounting policies to material accounting policies. They use the word material because IFRS is only applicable to material items. Okay, but it should be material in respect of the primary users. Now, who are the primary users? The primary users are existing and potential investors as well as lenders. Those users are regarded as the primary users. So, only your material accounting policies you have to disclose. If it's not material, you don't have to disclose such accounting policies. So they changed the words significant to material accounting policies. If you look at IAS 1 further on, they talk about the difference between current and non-current if you have a long-term liability. Let's, for instance, say you had a loan for 10 years already, and now that loan should be paid off within the next 12 months. If you go and see the bank before reporting date, then the condition exists at reporting date that you can defer it for another 5 years. You go and see the bank and you want to defer the loan for another 5 years. If that happens before year end, the condition exists at balance sheet date. And then that loan shall be regarded as a non-current liability. But if you go and see the bank after reporting date to postpone the loan for another 5 years, then the condition did not exist at the reporting date. And that loan shall be regarded as current because the condition did not exist at the reporting date. Very, very interesting. So I just want to highlight this quickly. It must exist at reporting date. Then, if you look at business combinations, they say that contingent liability shall be recognized. We know that. If it complies with the definition of a liability and the outflow is not yet probable, you will recognize the contingent liability in the consolidated financial statements. But it must comply with the definition of a liability. Very important, in paragraph 23A, it's now highlighted that contingent assets you will not recognize that in your consolidated financial statements. So if you've got a contingent asset, that will not be recognized in the consolidated financial statements. If you look at IFRS 16, they've changed how you deal with test runs. If you buy a new machine and you have to run test runs, what do you do with the gains and losses on the test runs? They changed. In the previous years, you capitalized the revenue and the costs. Now, the gains and losses on the test runs will go to profit and loss. Right. It will not be capitalized like in the past. You talk about provisions, and when it's an onerous contract, you will include all the costs to fulfill that contract. So if you have a contract and you're going to make a loss on that contract, that's an onerous contract, you will recognize all losses immediately, even though it's going to occur in future periods. Right. So you will recognize now. What will you include? All the costs to fulfill the contract, the direct material, the labor, and all other costs will be included. If you look at taxation, of course, deferred tax is exempted upon initial recognition. Now, take, for example, a lease. You'll capitalize a lease, debit right of use asset, and you credit a lease liability. In both instances, the tax base will be zero, but you will not recognize the deferred tax upon initial recognition. So that's just cleared in the standard now. Right. Now, if I move forward to the next topic, that's conceptual framework. They changed the conceptual framework. The previous conceptual framework was developed in 1989, the previous one. Now they've changed that. About 30 years later, 2019, they have developed a new framework. Why did they do it? Because the old framework was incomplete, it was out of date, and it was unclear. Why was it incomplete? It didn't make mention, for example, to OCI, other comprehensive income. The definitions of assets and liabilities were also outdated. And it's also unclear around stewardship, for example. Stewardship was in the old framework, but they've just elevated it, they've just highlighted it. Now, seeing that we've got a new framework now, all the other standards will eventually be harmonized with the new framework. And you will ask me a question now, what will you do when it's an old standard, not yet harmonized with the framework? You apply the old standard, not the framework. So you will apply the standards until such time that the framework is harmonized with the new framework. Until that standard is harmonized with the new framework. So you'll apply the old standard until such time it will be changed in the future. Now let's briefly say, what is the purpose of the conceptual framework? Is to assist the ISB to develop standards, to assist preparers of financial statements to develop accounting policies, and for others to understand IFRS. This framework This framework they address the objective of financial reporting. They also identify what information will be useful to the users.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.